All right, let's talk about something that completely changed the game for pretty much everyone who invests, the Exchange Traded Fund, or ETF. Seriously, this thing is a powerhouse, and you're about to find out exactly why.
So let's just jump right in with a question. Say you want to own a tiny piece of the entire American economy, the 500 biggest companies. For the longest time, doing that was complicated. There were always catches. So how do you get around that? Well, the answer to that question is really the whole story of the ETF.
To really appreciate why ETFs are such a big deal, we've got to turn back the clock a little. See, before they came along, investors were stuck between a rock and a hard place. You had two main choices, and neither one was perfect.
Okay, so here's the breakdown. On one hand, you had open-end funds, which you probably know as mutual funds. The great thing was they could always create new shares for new investors. But the downside? You could only buy or sell them once a day, at whatever the price was at the close. Plus, all that paperwork for every single investor made them kind of pricey to run. Then you had closed-end funds. These were cool because they traded all day long, just like a stock. But, and it's a big but, they had a fixed number of shares. That meant the price you paid could actually be way different from what the stuff inside the fund was actually worth. You were stuck.
So you can see the problem, right? Investors wanted the easy, all-day trading of one, but the fair pricing and flexibility of the other. It naturally led to a massive question. What if? What if you could just combine the best parts of both and get rid of the baggage?
And boom, that's where the ETF comes in. It's this brilliant hybrid solution that does exactly that. It takes the best of both of those older models and smashes them together into something new, something better.
So what is it really? At its heart, an ETF is just a big basket of assets. It could be stocks, bonds, even gold. But, and this is the key, the entire basket trades on a stock exchange just like it was a single stock, say Apple or Google. You can buy it at 10 a.m. and sell it at 2 p.m., with the price changing all day long. Okay, but how does it pull this off without falling into those old traps? Well, it all comes down to its secret sauce. This really unique, super efficient way that its shares get created and removed from the market. And this is how that magic trick works. Instead of dealing with thousands of individual investors like you and me, the ETF fund only talks to a handful of massive institutions. So first, the fund bundles its shares into these huge blocks. We're talking like 50,000 shares at a time. Then, those big players, called authorized participants, buy the blocks directly. Then, they're the ones who break up the blocks and sell the little individual shares to us on the stock market. It's a genius move, because it slashes the fund's operating costs, and those savings get passed right on to you. So because of that clever structure, the average person gets some amazing benefits. Honestly, I think of them as investors' superpowers. We're going to look at three of the biggest ones here. First, instant diversification, which is your shield against disaster. Second, something called built-in survivorship bias, which is like an automatic upgrade for your portfolio. And third, the power to bet on entire ideas, not just single companies.
To really get the power of diversification, let me tell you a quick story. Let's set the scene. It's 2006. The stock market is flying high, and two friends, we'll call them Jerry and Elaine, think the financial industry is the place to be.
Jerry's feeling confident. He's done his homework, and he decides to go all in on one company he thinks is an absolute rock, Lehman Brothers. Elaine, on the other hand, she knows she can't predict which specific bank will do best, so instead, she just buys the XLF, which is an ETF that owns a piece of all the big financial companies. So you have one guy with one stock and one woman with one ETF. Fast forward 2 years to 2008, the financial world collapses. Lehman Brothers, that invincible titan, goes bankrupt, and Jerry's entire investment? Poof! Gone. Worth absolutely zero.
Now what about Elaine? Her ETF got hammered, for sure. It lost a ton of value. But here's the thing. It didn't go to zero because it owned dozens of other banks. Some failed, but others survived, and many eventually recovered and grew stronger than ever. For Elaine, who just held on tight through the storm, her total return since 2006 would be over 100%. That is diversification.
Now for that second superpower. Get this, the Dow Jones is one of the most famous stock indexes in the world. When it started back in 1896, it had 12 companies. Of those original 12, guess how many are still around? Just one. And even that one isn't in the index anymore. The lesson? Companies die. And that's where survivorship bias comes in. See, an index like the S&P 500 has a rule. When a company fails or gets too small, it gets kicked out and replaced by the next big thing.
When you own an ETF that just copies that index, you get this amazing benefit for free. The fund automatically weeds out the losers and adds the winners. You don't have to lift a finger. Your portfolio just keeps evolving with the market.
Okay, so ETFs are diversified, they're efficient, they're easy to trade. This sounds almost too good to be true, right? Well, it's mostly true. But there is one critical detail you absolutely have to pay attention to, and that's the cost. That cost is called the expense ratio. Think of it as a small annual fee the fund charges to keep the lights on. You know, pay the managers, cover administrative costs, all that stuff. It's a tiny percentage, but it's how they make their money.
So how much does this actually matter to you? Let's do some quick math. You invest $10,000. After a good year, it grows to $12,000. Awesome. But wait, the fund has a 0.5% expense ratio, so they take out $60 for their fee. Your final value is $11,940. Now, $60 might not sound like a lot, but trust me, over 20 or 30 years, those tiny little fees can eat up a massive chunk of your returns.
And it's really important to note that there are two main flavors of ETFs. You have passive ETFs, whose only job is to blindly copy an index, like the S&P 500. A computer can basically do that, so their expense ratios are dirt cheap. Then you have active ETFs, where a real human manager is picking stocks, trying to be clever and beat the market. That human touch costs money, so their expense ratios are always going to be high.
So when you put it all together, it's pretty clear why ETFs have become such a fundamental tool for anyone building wealth today.
So let's recap the big takeaways. ETFs are that clever hybrid that gives you the best of both worlds. They're an amazing tool for instant diversification. They tend to be much cheaper than older funds. You can trade them anytime the market is open, and the most important rule of all, always check that expense ratio. And that kind of leaves us with a final thought to chew on. There's no question ETFs have made investing more accessible and more powerful for all of us. The old challenge used to be, how do I even get a diversified portfolio without paying a fortune? But now, with thousands and thousands of ETFs out there for every possible strategy you can dream of, maybe the new challenge isn't about how to invest anymore, but figuring out what in the world to invest in.